This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this session, we look at the disposals of two very specialised types of asset. The first of these categories of asset that we deal with, and a very well tested area in exams this is disposals of an asset group known as chattels. We will also then be looking at the disposals of, here's a name, other wasting assets that are not chattels. Now don't worry, the mystery of what they are and how we deal with them will be explained to you very soon in, again, the FA 2019 lecture that was used last year. These rules, again, have not changed like with our previous lecture. The rules have not changed for a very, very long time, and they're not likely to change in the future either. These are pretty much cast in stone. So you'll see the lectures from last year. Again, in terms of transactional dates, there may be differences there. But the computations that we do, the rules that we apply, the rules that you need to learn, are exactly the same. The only issue is at the end of the FA 2019 lecture, that stops having dealt with the other wasting assets that are not chattels. But new to FA20, to our syllabus, is this: payments on account for CGT on disposal of residential property. So when dealing with those other wasting assets that are not wasting chattels, there I do talk about this being the end of the chapter. Sadly for you, it's not now the end of the chapter, and we'll have to go on and deal with that section. So there will, after this lecture, be a newly recorded lecture for FA20 that deals with this specific subject area. Again, anything that is new, examiners, I think I've said it before, but they're like kids at Christmas. They can't wait to play with their new toy there. So no doubt in the forthcoming round of examinations, we're going to see something that deals with this. Again, before you go on to this, just go back and remind yourself before that final session, so after this one, remind yourself from early on in this chapter, what's the normal due date in relation to CGT? And then you'll see that it's a very different outcome, and you pay tax at a much, much, much sooner date on disposals of residential property than you will on any other assets. But that little pleasure awaits us again in our, what will then be, our very final lecture in this particular chapter 12 here. But so far as this lecture is concerned, it deals with these two areas, chattels and then other wasting assets that are not chattels there. And they will be covered within the FA 2019 lecture there. So I'll hand you over to me again last year to look at those two areas. But I say references to then that section that you can see on the screen being the final part is of course not true. We've got one final lecture that deals with that new addition to our syllabus, and that will be the payments on account that now apply on the disposals of just one special asset, residential property. Well, at the end of our previous session together, we looked at the particular problem attached to part disposals. Not really a big problem now, is it? We know what we've sold this part of an asset for, usually land there. We buy 100 hectares and we sell 40 hectares of that land. We know the sales proceeds. We know the selling expenses if there are any. The only problem is what's the allowable cost, as is so often the case in terms of a problem attached to your basic calculation of the gain. Inevitably, you know your proceeds, unless it's a gift, in which case you use market value, a figure already given to you. You've got to be told the selling expenses, but it's about the cost. Therein lies the problem. Now, what we have in a part disposal, you will recall, is the cost of the entire asset, only one part of which is now being sold. So we had a way by which we would take the relevant and correct proportion for tax purposes of that total original cost of the entire asset and determine how much of it is attributable to this particular part now being sold. What we did, of course, was to use the fraction A sales proceeds over A sales proceeds plus value remaining there, the market value of the remaining part of that particular property. And we multiply that out by the original cost to get the allowable cost of the part now sold. We do a value-based apportionment rather than a quantitative-based apportionment. It doesn't matter that you're selling 40 hectares out of 100. What matters is, what did you sell those 40 hectares for, and what's the value of the remaining 60 hectares? We did a class example, but I don't think I did, although you may already have done it, is to assign to you example 9. So if you haven't already done it, I'm sure you have, but have a go at that, please. Not a difficult exercise, again, as hopefully if you've learnt the rule here. What did we sell? Here it was 2 hectares of land. What did we sell them for? £16,000 there. What's the value of the remaining hectares? Value remaining 34,000. What was the original cost of the entire parcel of land, some 10 hectares of land? 26,000. So we know the proceeds are 16,000. We know the total cost is 26. The question is, how do we compute the allowable cost? You sold for 16,000. That was the sales proceeds. Over the self-same 16,000 plus, where's your value remaining? It's there. That will give you the allowable cost, the bit of the entire cost that belongs now, using this rule, to the bit that's been sold. Once you've got your cost, take it away from your proceeds, and of course you've got your gain. Again, check through the answer to that one, make sure you're happy with it. And that now leads us, therefore, to another situation where the basic gains or loss calculation, indeed, may be amended for specific circumstances. Now, it's a term that we used very early on, indeed in our first session on this particular chapter. The term was chattels, and we defined chattels as being, a chattel is tangible, movable asset, a tangible, movable asset there. What we'll also get to know now is that there's something called a wasting chattel, and that is said to be one with an estimated remaining life of 50 years or less. And the relevance of these is that these are exempt assets. And that's where we came across this term chattel when given our basic introduction to CGT. For a gain to arise, there had to be a chargeable disposal of a chargeable asset by a chargeable person. And the definition of chargeable asset was all assets are chargeable unless they're specifically exempted. And in that list of specific exemptions, and we highlighted it as being an important one for future reference, now is this reference, was certain chattels. Well, the certain chattels that are always exempt are these wasting chattels. Now, the typical examples that you see in exam questions would include racehorses, greyhounds, they're racing dogs rather than racing horses, and yachts or boats by any other name. So, tangible, movable asset is a chattel, wasting their estimated remaining life of 50 years or less at the point of sale. Those are exempt. No calculations to do. Doesn't matter what you sold it for. Doesn't matter what you bought it for. They are exempt. If we've got a non-wasting chattel, i.e. with an estimated remaining life of more than 50 years, examples here would include antiques, paintings, again it could be items of jewellery, antiques, various items of furniture, paintings indeed there. Any tangible, movable asset that isn't wasting, a non-wasting chattel here, we have special rules for. Again, we may see that the gain or loss is exempt. We may see that some of the gain only is chargeable, or that some of the loss, only some of the loss, is allowable there. Special rules to determine the chargeable gain or capital loss. Now, the first thing that we'll be aware of is that we have seen in a number of examples coming through in this chapter of basic capital gains calculation is we've been dealing with things like paintings, again, antiques, they're an item of furniture. We've actually been dealing with chattels. But in every one of those cases, what we find is that the cost was more than £6,000 and the sale proceeds was more than 6,000. And that 6,000, it's a chattel exemption limit that we'll refer to in a moment, is an important figure for us to know. But if we both buy and sell for more than 6,000, so you sold for 20,000, you bought for 12,000, it's a normal gains calculation. Proceeds 20 less cost 12, that's a gain of £8,000. But there's this chattel exemption limit below which the disposal is exempt. And it will be exempt where both the cost and the proceeds do not exceed £6,000. Our cost is 6,000, or as it will be an exam question, somewhat less than that, and our proceeds are less than £6,000, or indeed do not exceed £6,000. If we don't go above 6,000, then that equals exempt. So there are two very straightforward situations. You buy for 2,000, you sell for 5,000. Both the 2 and the 5 respectively do not exceed £6,000. If it is a chattel, it's a painting, it's an item of furniture, it's an item of jewellery there, then that is exempt. No calculations, it's exempt. We bought for 12,000, we sold for £20,000, normal capital gains calculation. What that leaves is that if one of the figures is below the chattel exemption limit and the other figure is above the chattel exemption limit, what do we do then? We know if both cost and proceeds are less than 6,000, it is exempt. If both cost and proceeds are more than 6,000, it's a normal gains calculation. So here are the two rules that are most usually tested in terms of an examination question. These are the rules that we must know. Firstly, what happens where the cost does not exceed 6,000, it's 6,000 or less, but the proceeds exceed, they are more than 6,000. What you've now got to do is two gains calculations. Clearly there's going to be a gain because you bought for less than 6 and we sell for more than 6 there. So normal calculation is firstly done. So proceeds less selling expenses less cost, get your normal gains calculation. But because the cost is less than £6,000, we now have a restriction on what we call the maximum gain. We do a maximum gain calculation. And if this figure is less than the actual gain, then that is the figure to use. The gain is restricted to a maximum of, here's your maximum gain calculation. The numbers you pick up from the question, the gross proceeds, again, before deduction of selling expenses, the gross proceeds minus the 6,000 chattel exemption limit. So you're simply looking by how much do your gross proceeds exceed the 6,000 chattel exemption limit. And then you apply to that a fraction. Now, don't start worrying where this comes from. It is an arbitrary number. Somebody decided, yeah, we'll use that particular fraction. It is 5 over 3. 5 over 3 times that excess of the gross proceeds over the 6,000 chattel exemption limit. Right, before we go any further, let's just have a look at some examples here and identify what the issues are based on our knowledge so far. So we're told here taxpayers sold a painting, and I've given you different figures of proceeds and different figures of cost to look at the different scenarios that we have outlined. Okay, the first one there, we sold for £5,200, our cost £2,000. Each of both the cost figure and the proceeds figure do not exceed £6,000. Therefore, exempt. Both the figure of proceeds and the gross proceeds and the figure of costs do not exceed 6,000, so the chattel exemption applies. Painting, as soon as you see an exam question, painting, antique there, item of furniture, item of jewellery, where you see that is tangible movable property, it's not a wasting chattel, then you are looking at these chattel rules. The last one here, we sold for 12,200. Well, that's more than 6,000. You bought for 8,000. That's more than £6,000. So on that basis, it's a normal gains calculation. The normal gains calculation would be a simple one. Sold for 12,200, less selling expenses of 200, net proceeds 12,000, less the £8,000 there cost, and therefore a £4,000 gain will arise. Perfectly normal calculation. Okay, those are the two more straightforward circumstances, just basic rules to follow. And then we have this one, where our gross proceeds at £7,200 exceed the 6,000 chattel exemption limit. But the cost figure at just £3,000 falls below that chattel exemption limit. Therefore, what do? We first of all compute an actual gain. So a perfectly normal calculation as we just did in that final exercise there, here, this one, where both cost and proceeds were above 6,000. So here we go. Our gross proceeds were 7,200, selling expenses 200, so our net proceeds 7,000. Take away the allowable cost, we are looking at a gain again of £4,000. But on this occasion, there is now a maximum gain calculation to apply. That is always that maximum gain fraction, 5/3 times. Now, what figure do we want from the specific information provided here? It's not the net proceeds, it's the gross proceeds. Our gross proceeds, 7,200, minus the chattel exemption limit of 6,000. So by how much does the gross proceeds exceed the chattel exemption limit? That's 1,200. 5/3 times 1,200. Well, if you put that through your calculator or do it in your head, that therefore 1,200 divided by 3 will be 400, times 5 will be 2,000, methinks, but just check it through the calculator. Now then, which gain do we use? This is the maximum gain here. So if this figure, as it is, 2,000, is less than the actual gain, then that is the figure to use. If this maximum gain had come out as a figure bigger than the actual gain of £4,000 there, we would simply use the actual gain. This is a maximum. So we therefore will apply this maximum to restrict the amount of actual gain. If it doesn't restrict it, if the actual gain is less, we simply use the actual gain. So do two calculations, an actual gains calculation as you normally do, and then compare that gain, £4,000, with the maximum gain, 5/3 times the excess of the gross proceeds over the chattel exemption limit. Okay, let's go back to our notes now. There's one other situation. In that previous one, we bought for less than 6 and sold for more than 6. What we've got this time is that the cost exceeds 6,000, but our proceeds less than 6,000. So on that basis, there's going to be a loss. So what happened when these figures were reversed? Pardon me. We restricted what the gain would be. We computed a maximum gain. We limited the amount of gain that would be chargeable. So this cuts both ways. Where we have bought for more than 6 but sold for less than, there will now be a limit to the allowable loss. And unlike in the gain scenario of a moment ago, where we did 2 calculations, here there's just one. And there's one simple rule to remember. That is that we now take our deemed gross proceeds, again note gross proceeds, and deem the gross proceeds to be £6,000. And in that way, we're going to limit the amount of allowable loss. So we deem the gross proceeds to be £6,000 and then do a normal loss calculation. Right, if we just go back to the example I was working with you here, there's one remaining situation to look at here. Our gross sales proceeds are £4,200. That does not exceed £6,000. Our cost figure, £7,000. That does exceed £6,000. If we had bought for £5,500 and sold for £4,200, then both the cost and the proceeds being less than £6,000 would mean that the chattel exemption automatically applies. That means that there would be no allowable loss that would have arisen. It would simply be exempt. So what happens now where the cost is above £6,000 and just the proceeds are less than or do not exceed £6,000? We limit the loss. And how do we do it? We do a single calculation where we take our deemed gross proceeds to be £6,000. Notice gross proceeds. That means that we still get to deduct from those proceeds any selling expenses, which I think in every one of these cases was £200. Yeah, £200 there. Take it away, and therefore net proceeds some £5,800. Take away our allowable cost. The cost was £7,000. Let me just check. I think it was £7,000. Yeah, there we go. Allowable cost £7,000. And that, therefore, will give us an allowable loss of £1,200 there. So it's a perfectly normal loss calculation with one exception. We deem the gross proceeds to be exactly £6,000, the chattel exemption limit. Do remember it's gross, so we still get to deduct the selling expenses in determining the net proceeds, and then we deduct the cost. Now, of course, this is likely to be an objective testing question. I've shown you there the proper full structure. All you'd have to do in terms of an exam question is to get the right answer. You wouldn't be writing any of this stuff out here. You would simply have picked up, what are my deemed gross proceeds, 6,000, what are my selling expenses, 200, so my net proceeds, 5,800, what is my allowable cost, 7,000, and there's my allowable loss of £1,200. You wouldn't do any of the writing. That is only there for tuition purposes. You, of course, again, kept no marks for your workings. You simply get the 2 marks or no marks, depending on do you select the correct option. So again, no need for you to be writing this out, but again, follow a proper process at least so that you don't make any silly mistakes along the way. Okay, there's our rules in relation to chattels. You've got example 10 here with a series of scenarios to deal with, some 4 individual disposals. I'd like you therefore to pause at this particular point and have a go through example 10, and then we'll do a quick review of what we see in there. Okay, well, let's see how we fared with example 10 therefore. Now, obviously, each of these examples just follows on from the particular issue that we were dealing with. So you are used to, you've got in your heads, chattels. Remember, when you come across an examination question, I haven't just been talking about chattels for the last 20 minutes to you. You've got to recognise what that situation is. So it's all about identifying what the scenario you're dealing with is, and then recognising the technique that you need to use to solve that problem. So what have we got? JM here sold the following assets in December 19. So what we read in the question is an antique table. We don't read chattel. Doesn't say that. You have to make that link that here we're talking about tangible, movable property, an antique table. This is not a wasting chattel. We mentioned those earlier, that they're such examples of disposals like racehorses, greyhounds, yachts. They would just be exempt. This, therefore, is your normal chattel, so we're now starting thinking about the £6,000 rule. Right, cost £3,000, sold for £5,000. Yeah, the 6,000 chattel exemption rule applies. Each of the figure of cost and then the gross proceeds do not exceed £6,000, so it is exempt. So, nice, simple first one, exempt. If we had part B to deal with in a question, a painting. Well, again, that's tangible, movable property. This is a chattel. This time, cost £2,000, so again, it's less than £6,000, the chattel exemption limit. But of course, we sold for £10,000. So where you've got a chattel bought for less than 6, sold for more than 6, we do the two calculations. You do your actual gains calculation. Well, that's simple enough. There's your proceeds at 10. There's your cost of 2. And then you do your maximum gain calculation, whereby we take that standard given fraction, 5/3, and multiply by the excess of, now here I just said sold for, we'll take that as the gross proceeds, the amount by which those gross proceeds, 10,000, exceed the chattel exemption limit, being 6,000, and we take that 10 minus 6 times 5/3. If that is, as it will be here, I think less than the actual gain, then on that basis we are talking about that maximum gain applying. It's again a maximum figure. If it is lower than the actual, you use it. Next one, an antique vase. Again, remember, in the exam we've got to pick up that that is a chattel. Which had cost £6,000, that's more than 6, sold for £3,000, that is less than 6. As with part B, part C is the other most likely scenario to be tested, where there's a bit more interest in terms of the calculations and the rules that apply. And all this is, of course, is that we'll now limit the loss. How do we do that? We deem the gross proceeds to be 6,000. Though you actually sold for 3, you deem the gross proceeds to be 6. With a cost of 8,000, that's going to be a loss restricted to £2,000. And then we come to D. Now, I wonder how many of you got this one right. Or were we lulled into, and hence this discussion that I'm having with you now, the idea of, oh yeah, it's an examples on chattels, this is a vintage car. And therefore, you proceed to deal with the normal chattel rules. Where it's cost 7,000, sold for 9,000, it will be a normal gains calculation. If you did that, you did it wrong. Because what you had to think back to was that original definition of a chargeable asset. And all assets were chargeable, we said, unless specifically exempted. And as well as certain chattels being on that list of exempt assets, there was another most obvious one. Cars, vehicles available for private personal use there. And we said at the time, it doesn't matter whether that is a vintage car or not. All that matters here is it's a car. And therefore, that is on your list of exempt assets. Therefore, these numbers are entirely irrelevant because it is exempt. Whether those numbers are less than 6, more than 6, whether one is below and one is above, it doesn't matter. That is exempt. Vintage car, it is a car, that is exempt. So be careful. Again, the point to remember when you practice during your revision phase is that as we've gone through step by step, chapter by chapter, section by section, you've immediately done examples that were based on the things I just spoke about. So it was in your head. In an exam situation, as you will be well aware, you have to identify, you have to recognise what situation you're dealing with, plucking from that brain of yours the relevant file that deals with that particular issue. Here it was about on the first three. These are chattels, deal with the chattel rules. On the last one there, part D, this is a car, that therefore is an exempt disposal. It is separate to the chattel rules. A car is an exempt asset. Okay, now that leaves us with just one area now to deal with. Of course, then I'm sure you have done it already. Just go through to the back in the book and look at the solutions to the example I've just taken you through. Make sure you have indeed got all those issues sorted and you recognise them in the future. Right, last section. Now again, we're dealing with these odd circumstances, the ones where there's something different about the gains calculation. It's not just the proceeds less selling expenses less allowable cost calculation. There's something different. And as we said, quite often it is about computing the allowable cost. If there's a problem, it is often, how do I get the allowable cost? I may have a total cost figure, but like with a part disposal, how do I work the allowable cost? Well, before we go into this area, other wasting assets, remember, a life that does not exceed 50 years, that are not chattels. Chattels were tangible movable property. So we're talking here about an intangible. We're dealing with intangibles. And an example of such a wasting asset that we'll deal with shortly, which is not a chattel, is a copyright, an intangible therefore. Now again, the problem is about cost. If it's a wasting asset, then as that life of that wasting asset expires, as it becomes less and less, then notwithstanding other valuation issues, the mere fact that it's now only got 10 years of life in it compared to 20 years of life in it when I first bought it means that the value would be less, the value would go down. Something with a 20-year life as compared to an equivalent asset with a 10-year life is going to be worth more because it's got a longer life. You've got a better and longer use out of that asset. So what we'll see is that when we do a gains calculation, we of course pick up as ever our proceeds, any selling expenses, but then it's about the allowable cost. And that total original cost is not going to all be allowed. It's going to have to be reduced. It's going to be depreciated down to what we will take as an allowable cost. And that's what this working is all about. Now, I'll come to that in a moment, but let's put this in context, going back to our introductory note on chattels. We defined that a chattel was tangible movable property, a wasting chattel, so it's still tangible movable property, but wasting means an estimated remaining life of no more than 50 years. Any such wasting chattels were exempt assets. What we'll be dealing with, of course, is something that isn't a chattel. It's an intangible, not a tangible asset there. One other issue here while we're on this subject. There is, in the case of wasting chattels, an exception for plant and machinery. Now, clearly plant and machinery is tangible movable property there. And it's likely to have, when disposed of, an estimated remaining life of 50 years or less. A lot less, we would imagine there. So there's an exception for plant and machinery. But that is only on which capital allowances have been claimed. These assets are treated as non-wasting chattels. So, If plant and machinery is not covered by the non-wasting chattel exemption in note D below, remind ourselves what that was. If you bought an item of plant for 3,000 and sold it for 5,000, each of those figures is less than the 6,000 chattel exemption limit, so that would make it exempt. More likely, I buy it for 5, it's now worth 3. That is exempt. So if the figures of cost and proceeds again are less than 6,000, the chattel exemption rule applies. So if plant is not covered by the non-wasting chattel exemption, then a gain would in fact need to be computed upon its disposal. But such a calculation is seldom required. Why? Because it's incredibly unlikely that any item of plant and machinery that you have used within your business is subsequently sold for more than its original cost. But examiners, of course, can use whatever numbers, whatever situation they wish to use. So if you had a situation where there was an item of plant and machinery that was bought for 100,000 and sold for £140,000, then it has been sold for more than cost, and therefore the chattel exemption doesn't apply because it's well more than £6,000. You'd have a £40,000 gain. So that gain would be chargeable. But it's not likely to happen, is it? The more likely situation is we buy it for 100,000, we sell it for 40,000. Now then, that means you've made a loss on that disposal. Bought for 100, sold for 40. But there is no capital loss that arises here. Now, your immediate thought is, it's not fair. If we sold for 140, having bought it for 100,000, that's a gain. But if we sell it for 40, having bought it for 100, there is no loss. Now, it's not unfair. The reason why there is no allowable loss is that this asset, remember, the plant and machinery, has already ranked for capital allowances. So in the capital allowance computation for the business concerned, you put in an original 100,000 cost to that capital allowance computation. If you'd sold it for 140,000, then when you sell, you take sales proceeds but to a maximum of original cost. Therefore, you would limit the deduction in relation to the proceeds to the original cost of 100,000. So you put 100,000 in, you take 100,000 out. That would mean that you've had no net cost of ownership and therefore no net allowances would be available to you. Anything that you've already had, which you may have done, may be clawed back there, either in the form of a balancing charge at this point or in the form of a reduction of allowances in the future. So in which case, we've put the cost in, we've taken the cost out, 100, 100, in the capital allowances computation, so that's fine. But what we haven't yet done is to deal with the fact that we sold it for 140 and therefore we haven't dealt with the gain. So you do a separate gains calculation, £40,000. But if you sold it for 40,000, then think, in your capital allowances computation, you put 100,000 in when you bought it. You'll have claimed whatever allowances, whether that was AIA, whether it was a mix of AIA and WDA, whether it was just WDA. You've claimed allowances. And now you've sold for £40,000. So in your capital allowance computation, obviously divided by time from when you bought to when you sold, but you put 100 in and you've taken 40,000 out. Therefore, you have left within that capital allowance computation £60,000 of net cost. And that 60,000 net cost will have been compensated for within the capital allowances system. And capital allowances have reduced your trading income assessment for either income or, as we'll see later, corporate tax purposes. So you've already had tax relief of 60,000 based on putting 100,000 into the capital allowance computation and taking £40,000 out. It's left 60,000 within the capital allowance computation for capital allowances to have been claimed on. Capital allowances have reduced the trading income. You are not going to get, for the same £60,000 loss, both a capital allowance reducing trading income and also get a capital loss to reduce the capital gain. That would be giving the benefit, as it were, of the loss relief twice over against both income and also against capital gains. It isn't going to happen. Now, again, you don't have to understand why, you simply have to deal with what the issue is. So in terms of plant and machinery, if the chattel exemption applies, bought for less than 6, sold for more than 6, it is exempt. If we are looking at numbers on individual items that exceed £6,000, then if sold for more than cost, there would be a capital gain, but incredibly unlikely in real life. If, as is normal, we simply sell for less than cost, there is no capital loss to compute, and everything is dealt with, as you've seen already in Chapter 5, within the capital allowances computation. You put the original cost in the accounting period it was bought, you took your sales proceeds out. Anything that's left in, you just continue with writing down allowances thereon. But you will be able to claim your tax relief for that net cost through the capital allowances system. That reduces trading income. You do not also get a capital loss. Okay. As I said, capital loss will not, however, arise in this situation, as capital allowances would already have given tax relief for the net cost of ownership of the asset. But there we were dealing with wasting chattels. This last section of our notes here to finish the chapter is a wasting asset, so a life of no more than 50 years, but not chattels. We're dealing with intangibles. And the best example of that I could give you would be something like a copyright. The problem, remember, as it's a wasting asset, as the life ticks by, the life wastes away, and hence you'd expect the value, all other things being equal, to go down. If you have an equivalent asset with a 20-year life as compared to a 10-year life, you would pay more. You'd be able to sell for more the 20-year life asset compared to the 10-year life. So what that means for HMRC is that as that value goes down, and it will go down and down and down until it gets to the end of the life, and therefore it has no value other than maybe a scrap value, as we'll see in a moment, then if HMRC were to allow simply all of the original cost to be an allowable cost, then you'd be giving allowable losses. Now, of course, HMRC don't really want to give allowable losses. What will we do with them? We'll go on and put them against gains, and that therefore would reduce our CGT liability. So what do? They have now the requirement in this situation, when dealing with a wasting asset that is not a chattel, like a copyright, is that the allowable expenditure is deemed to waste away over the life of the asset. So when a disposal is made, the allowable expenditure is restricted to take account of the asset's natural fall in value. As time goes by, as it wastes away, that issue alone would serve to reduce its value. This fall in value is deemed to occur on a straight line basis over its predictable useful life. Therefore, to compute the allowable cost, herein, like with a part disposal, herein lies your problem, getting the allowable cost to go against your net proceeds to work out any gain or loss that now arises. However, to compute the allowable cost, the original cost, of course a given figure, must therefore be reduced, not to, by. Hence I put it in capitals. Must be reduced by. So the calculation you are going to do is not directly to compute the allowable cost. This calculation is the reduction in the original cost to then leave you with the allowable cost. So, reduced by, what's the calculation? Well, here, C minus S. C, obviously, the cost of the asset, minus S, which may or may not be given in an exam question, as it may or may not exist, if there's any scrap or residual value at the end of the asset's predictable life. So if it is got some value at the end of the life, it's effectively the net cost that we're taking, the original cost less the scrap value. And we're going to reduce it for the period of ownership that we have had, the taxpayer has had, because we're going to multiply it out by P over L. P, the period of ownership of the seller. So that how many years have we owned that particular asset? Over L, the predictable life of the asset on acquisition. What was the predictable life of the asset on acquisition? As luck would have it, here we have a final example, example 11, to deal with this situation and to complete this particular chapter. Calculate the chargeable gain arising on the sale of the copyright in December 2019. So you've got to pick up copyright. What is that? It's an intangible, it's not a chattel. But a copyright, as you'll see from the information provided, is a wasting asset. It will have a life of not more than 50 years. So we're going to have to restrict the allowable cost in any gain/loss calculation. So what have we got? On the 1st of December 7, Z bought, there's our copyright, cost 25,000. There's our original cost. On acquisition, it had an estimated useful life of 30 years at that point. It also had an estimated residual value of £1,000. So in terms of the letters and the issues that have to go into this calculation, remember the reduction in the original cost to get the allowable cost. We know the cost of the asset. We know the scrap value. We also know the predictable life of the asset on acquisition. Z sold the asset for 38,000. So there we go. We've now got our sale proceeds, 38,000, on the 1st of December 19. A bit of time apportionment is going to have to be done. 1st of December 7, 1st of December 19. Therefore, we'll be able to work out, if we bought it on the 1st of December 07, sold it 19, 12 years have expired. That's the period of ownership of the seller, and we've now got all of the numbers for the designatory letters that need to go in to our calculation of the reduction in that original cost to give us now the allowable cost to work out any gain or loss. Just one issue, so I'm not trying to here trick you with the numbers that I put in, but what you might have noticed is that the original cost, so when it had an estimated useful life of 30 years, was £25,000. And yet some 12 years later, we're able to sell that asset for more, £38,000. Yeah, what you have here is, and I've done this deliberately with these numbers, I've given you a proceeds bigger than cost. Your presumption may have been that as time goes by, the value would go down. And as a standalone issue, of course it would. But there are other factors that affect at any point in time the market value of a copyright there. That will be dictated by fashion, by taste, by what people like. Suddenly, this, under your ownership, this particular copyright has become more valuable. The point I'm making is whether the actual value at the point of sale as here has gone up, or as you might have expected would have gone down. It doesn't matter. The calculations that you do are exactly the same. So better you meet this situation now rather than for the first time in the exam. Okay, over to you. You know what you've sold it for. You've got to work out the allowable cost. You have a go at that now. So pause this for one final time here, and then I'll quickly take you through the answer to that to make sure you've got no problems in it. And that will bring this, well, quite long chapter, of course, on capital gains tax to an end. Okay, well, hopefully, therefore, no problems with our calculation of what turns out indeed to be a chargeable gain. If my math is correct anyway, £22,600 worth. Where does it come from? We know the sales proceeds, £38,000. If there were selling expenses, you would deduct those as normal to get net proceeds. Less acquisition cost. We know the original cost was £25,000. We then need to reduce that by. And our calculation, of course, we know the cost was 25 and we know the residual, the scrap value of that at the end of its 30-year life was £1,000. 30-year life, how many of those 30 years from the point of acquisition have expired to the date of disposal? 12. That's the bit that we've used up. We therefore reduce our allowable cost by that figure. We get our allowable cost deducted as ever from sales proceeds, and you've got yourself your chargeable gain, or indeed in other circumstances, what you might think to be more likely, an allowable loss figure. Okay, that completes, therefore, Chapter 12, a long introduction dealing with all of the important basics to do with capital gains tax. We've got 2 more chapters on CGT for individuals. We then have separate chapters after we've been introduced to corporation tax that looks at the particular issues about computing gains or losses for companies. So we'll be reintroduced to it corporate tax, chargeable gains for corporate tax purposes in later chapters. The 2 remaining chapters dealing with individuals, the next chapter deals with a very particular asset and one that is frequently, indeed usually tested, and that's the disposal of shares, where yet again the problem that we have seen already within this chapter, certainly in the latter part of this chapter, is that when you sell some of but not all of an asset, how do you know the allowable cost? We've dealt with the generic part disposal rule. What we'll be looking at in terms of shares, of course, is I buy shares in a particular company, not just at one point at one figure of costs, but spread over a number of years at lots of different costs. I then sell some of those shares. Which ones? Is it the ones I bought 10 years ago, 1 year ago? Which one is it? And therefore what cost to use? That is dealt with in Chapter 13, along with other specific circumstances pertaining to the disposals of shares and securities. Chapter 14 we have referenced already back in our introduction to say that's where we deal with reliefs. There are certain names of reliefs that we have mentioned, but we do not yet know the details of. But that too is a hugely important chapter. It, as most of these chapters are quite long, and it deals with all the individual reliefs that we need to know. And reliefs that are in different forms. Reliefs that are deferrals, a relief that is an exemption, and a relief that in fact is just a lower tax rate. More of that, though, in the relevant chapter.